Welcome to SB Talks. Today is Tuesday, April 22nd, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will discuss the war of words from the US President to the Fed. We'll talk the latest on tariffs, as well as the upcoming US earnings season. Welcome to all our listeners. Now, we were discussing just before we started recording that almost as soon as you finish recording anything these days, it's almost instantly out of date. And unfortunately, that is the state of affairs that we're currently dealing with. But we will today try our best to sort of take you through where we're up to. And maybe we'll start at the top and the emerging or intensifying war of words from the US president to Jerome Powell.
Yeah, so I think there was a Truth Social post over the break talking about Powell being Mr. Too Late and a loser for not cutting rates. So certainly an amplification on the pressure on Powell to cut rates. And that's at odds with what Powell said, I think, last week at one of his addresses to the Chicago Economic Council, where he quoted Ferris Bueller and said, to quote another great Chicagoan, life moves pretty fast.
It certainly
and
does
that's certainly
right now.
an apt description of the time that we're living in. And at that speech, he indicated that, look, they're really in a very uncertain environment. Tariffs are potentially inflationary. Now, while we've spoken about tariffs potentially having a sort of one-off impact on inflation or transitory inflation, we know that the Fed's been dealing with transitory inflation for the last 3 years. So they are concerned that the impact on tariffs could impact inflation, and that means that they really wouldn't be able to cut rates even if unemployment started to rise. And I think that's what's angered Trump, suggesting that rates might stay stable or even potentially increase to tackle inflation.
To respond to some of the inflationary threats from the tariffs. Now, as I understand it, Chairman Jay Powell's term is through to May 26. But we know that this current administration is not necessarily one that's a stickler for the rules. And it does draw significant question marks over, I guess, the ability for the Fed to operate independently under this sort of scrutiny and pressure.
Yeah, I mean, I think the risks of Powell being fired are actually pretty low. So the 1913 law that sort of formed the Federal Reserve System sort of makes it fairly clear they can't be fired unless for cause. There's also a case from 1935 called Humphrey Executive versus US, where FDR, Roosevelt, tried to fire one of the federal trade commissioners, and the Supreme Court ruled that anyone in a sort of quasi-judicial or quasi-legislative role cannot be fired by the president. They can only be fired under rules set by Congress.
So the actual whole premise of the US system, separation of powers.
Yeah.
But we're really seeing that one stretched to its limits under executive orders and other mechanisms.
We are. But the thing is, even if he was to fire Powell, I mean, there's 12 people on the Federal Open Markets Committee that sets rates, and most of those people would still kind of target inflation. So even if the chairman, wasn't Powell or someone would be someone else, probably Deputy Chair John Williams from the New York Fed, they would still have a similar view. So it doesn't necessarily achieve a lot, and it's taking on a fight at a time where a lot of people are questioning the US the primacy of the US dollar and the safety of the US Treasury bonds.
Let's
and
talk
all
about
of
that a little
stuff.
bit, because we know in times of crisis, money typically flows back to the US. The US dollar is the safe haven. It is the world's default currency for business. And the just extreme erratic nature of what we've seen over the last couple of months has started to people question around the medium-term sustainability of that world order.
Yeah, I think it has called into question, whether these assets are safe havens, particularly when you have erratic policy, and potentially people questioning the independence of the US Federal Reserve System. So it's not good for confidence in the system. The reality is, though, where else do people put their money? And the US
Gold.
Yeah, gold, gold potentially.
It's done well in recent times.
Yeah.
Not
So I
necessarily
think
through the last wave of inflation.
I think we are certainly seeing people looking to diversify, potentially move some assets out of the US, and that's I guess understandable. So that trend could definitely continue. The US dollar has weakened overnight. It's the lowest level on the dollar index for 3 years. The US 10-year has sold off, so it's sort of, it's quite unusual for yields to go higher and the US dollar to go lower and the US equity market to sell off. So I think all of this, plays into that theme that people are looking to reallocate money out of the US.
Applying a different risk to the US system as a whole and the assets that sit within it. We were talking before as well about some of the data that we're seeing. Obviously, we started the year with a reasonably solid growth momentum in the world economy. It's hard to really get a read of it at the exact moment in time, just because the policy changes are coming so fast, and many of them being sort of reversed and changed at short notice as well.
Yeah, so any of what we call hard data, so things like non-farm payrolls in the US, anything that's sort of backward looking is still pretty good.
As in the numbers are still showing a healthy economic state.
US retail spending was fairly strong. Arguably some people kind of front loading to try and get in front of the tariffs. But generally anything that's sort of backward looking on the consumer or the labour market's been pretty good. Even in Australia, we had another good labour
employment number
report for March. Unemployment essentially steady at 4.1%. So that's all good. But anything we talk about survey data or soft data is incredibly weak. So, for example, the US has this thing called the Philly Fed index, which, looks at businesses around the Philadelphia area. And that's the weakest for 2 years. And it's also one of the weakest in a non-recessionary environment. So new orders collapsing, forward employment collapsing, prices going up. So, stagflationary messages coming from that. We get a lot more of that sort of data this week. So the PMI data probably showing similar things. So businesses really nervous about the outlook, and consumer sentiment also particularly weak when they survey consumers.
So, not surprising, really. You're sitting in the US, you're a business decision maker, and you have to make an investment decision. Pretty hard to make it in this environment, and consumers, I think, are just going to look after their dollars a little bit more closely for the immediate weeks ahead while we see how this plays out.
Yeah, absolutely.
What are we seeing elsewhere in the world? Any other ECB met?
Yep, so the ECB met last week, and, there had been some sort of views having, made a lot of cuts kind of in the back end of last year that they might pause in April, but no, they cut 25 basis points of the deposit rate down to 2.5%. People seeing that potentially go down to 1.5, somewhere between 1.5 and 2 over the next sort of 6 to 12 months.
Lowering the base level there, obviously, given the economic environment that they're facing. Yeah,
obviously Europe's quite trade exposed. I mean, the good thing for Europe is, unlike the US, they're not going to be putting up tariffs, so there's no real inflation impact, and people are expecting that the Chinese try and look to reallocate or resell some of those goods that might have gone to the US to places like Europe and Australia, so that actually pushed goods prices down, so deflationary. So that's positive. Allows the ECB to cut rates and not do what the Fed's doing, where they're kind of sitting on the fence.
Hold their armour back. Anything else catching your attention out there?
We obviously have, we're in the start of earnings season, quarterly earnings season in the US, so it'll be interesting to see what companies say. I mean, they'll probably report reasonably good results.
But the expectation is guidance. It's all about the guidance and who's going to be confident to offer any guidance.
Yeah, absolutely. So I think that'll be very interesting. Obviously, there's still quite a lot of this tit for tat between China and the US, so that's sort of keeping investors wary. So, the latest round is, I think, the US has put these port charges on Chinese-owned and Chinese-built ships arriving in the United States, potentially up to $15 million for a Chinese tanker arriving at a US port. It goes from $5 million but up to $15 million. So
just to land and disembark its cargo.
Yeah. So there's that, and then there's now China is saying, there's a whole talk around secondary tariffs. So China's trying to push some of its trading partners not to agree to US trade deals that sort of seek to isolate Beijing. So it's almost like forcing countries to make a choice between the US and China. And for a country like Australia, that could be potentially quite a challenge.
Yeah, quite a challenging decision to make there.
We're required to make that. So I think it's very interesting just watching all this stuff going on. It makes it very difficult as investors to try and look through it.
And how do you approach that? Putting your investment hat on.
I think you just have to kind of try and look through the noise and think, okay, where could this potentially end up? And so at the moment, we're in this phase where Trump's trying to do 90 trade deals in 90 days.
Yep.
Is that possible? Well, based on early discussions with countries like Japan, maybe that's not likely to happen. But maybe he'll cave in a little bit on some of these and just be seen to have done these sort of deals that maybe incrementally are beneficial to the US, not necessarily moving the needle that much, but he'll be able to declare a win. So I think there's one view that's a reasonable prospect. And then we'll kind of move on once we get through that sort of these sort of cosmetic trade deals. Over the next 90 days, we move on. If it drags on longer than that, then I think it's a much rockier road.
Yeah, well, you're going to have a continuation of all those challenges you described around the lack of investment decisions, the consumer caution, the company guidance. It all sits in limbo while this drags on, and also we're not seeing any of the tax sweeteners on the other side.
No, well, that's right. And they're sort of things that would happen probably after that 90-day period is up.
And theoretically, once the tariff revenue was known to actually, because they need it to balance the budget, to a degree. An excellent summary. Thank you, Nick. We watch with some caution in this rapidly unfolding situation, but thanks for your insights as always, and thank you to all our listeners.
Thanks.